First Property Group reported half-year profits before tax of £2.08 million, down from £2.98 million in the same period last year. Revenue was also down from £8.08 million last year to £6.33 million this year. Now, shares are trading a little bit lower in terms of today's trade. And joining me to discuss the outlook is Ben Habib. He's the CEO at First Property Group. Ben, great to chat to you again. Tell us what's behind the fall in profit this year.
Well, surprisingly, it's not really principally down to the COVID pandemic. It is because we sold our largest property, the sale of which completed in April. And so we lost quite a lot of the income that we would otherwise have earned on that property. As we all know, cash earns nothing. But we have, in the sale of that property, converted a property asset into cash. And it was a great time to be doing it because we're now going through this economic recession, pandemic-induced economic recession, really with a very strong balance sheet. We've now got £21 million of cash on the balance sheet. That represents about half our market cap. So that's why the profits have gone down. We simply lost rental income when we sold the property.
Okay, so what about the pandemic then? Obviously, this has been an unprecedented year for the market. How has COVID-19 effectively impacted your business?
Well, we've had a fairly mild impact as far as the numbers are concerned. We've had some valuation reductions, and we've had, as a result of that, asset management fees dropping. And we've also had some tenants not paying. But if you look at our rental collection rates, actually, they've been very, very high, much higher than the industry average. What we have done on occasion where a tenant genuinely has been suffering, and this applies more to retail tenants than office tenants, is give them a rent-free period in return for an extension in their lease period. So we've driven value at the expense of short-term income, which seemed like a fair arrangement for us where tenants were under the cosh. And the benefit of that from an accounting perspective is that you amortize the rent-free period over the life of the lease. So you don't see that hit in the accounting period. So whilst we've had some cash reductions, cash intake reductions, by managing concessions in that manner, we've avoided taking a hit in this last 6 months. So really the pandemic is only a few £100,000 worth of the reduction in profit, with the largest slug of it being as a result of selling that property. Of course, we're not out of the pandemic-induced shutdowns and economic malaise. And what remains to be determined, of course, is to what extent that's going to impact us going forward. At some point, governments have to stop locking down the economy, and they've got to let us get back to work. Otherwise, the economic scarring is going to be disastrous.
So on the economic malaise, I mean, how optimistic or pessimistic are you about the overall economic recovery from the pandemic? And what about the recovery for the property market itself?
Well, I think it's all about employment for me. It's not about government debt levels. And I saw Rishi quoting a figure of 2.6 million unemployed forecast for March next year. I think, frankly, that is a complete misrepresentation of the number of people outside work. That figure that he used really relates to those people who are actively looking for employment. But if you look at the economically inactive portion of the population, it's going to be about double that. And of course, that has a direct impact, Victoria, on rent levels. If people are unemployed and they're staying at home, there's less demand for space in the economy, there's less spending taking place. That impacts the office sector, it impacts the retail sector, it'll even impact logistics. So the real $64 million question for the Chancellor of the Exchequer, which he didn't answer yesterday, is how does he get the economy moving again? How do we get growth? I'm not worried about debt levels. Half our government debt is owned by the Bank of England. So it's just fictitious. They've managed to get away with printing money without the markets nobbling them on it. Great, terrific. Now, how are they going to grow the economy to make sure the unemployment are back in work, that tenants can therefore, that there's demand for space from tenants and tenants can therefore afford to pay their rent? That's the challenge. And so what I'll be watching over the next 6 months until the furlough scheme ends is, what steps the Chancellor's taking to really get the economy motoring forward. And if we don't see any definite signs of a pro-growth strategy, we will be much more reluctant to invest than we would be.
So it feels as though the pandemic has expedited some trends in the property sector that were already there, whether it's the changing face of the high street or the way that people work, with increasing people working from home or flexible working. And certainly that's changing the way that the property market looks. How does that impact your investment horizon, your investment opportunities as you look towards next year and beyond the pandemic?
Yeah, well, I think the high street is very challenged. And shopping centres are very challenged. And I think they're particularly challenged from a property perspective, not just because of the changing social behaviour, but because alternative uses are very limited. There's not much you can do with a string of shops down a high street. There's not much you can do with a shopping centre that's totally inappropriately designed to convert to residential. And what you've got there is the requirement to knock down and rebuild and re-engineer completely. And that comes with a large cost associated with it. So I think those two sectors are going to continue to be in the crosshairs of the storm. The areas that I think will probably recover faster and where there'll be more opportunity to invest will be in offices and in retail warehousing, and supermarkets, actually. I mean, supermarkets have kind of come back into their own, having had 5 years of a really miserable time. Supermarkets are suddenly trading quite well. So the areas we'll be looking at are offices, where we don't think the impact's going to be massive and where we've got alternative uses like residential. We'll be looking at retail warehousing, where again, the impact hasn't been as bad as the high street or shopping centres. And again, there are things you can do with a retail warehousing scheme because of the large expanse of land and the relatively cheap proportion of the relatively small proportion of the value of the property being in the buildings. You can knock them about and still create value. So those are the two areas we'll be looking at more aggressively in the UK. As far as Poland is concerned, which has had a much better economic run, as it always seems to do, than the UK, we're more agnostic on particular sector, and we'll be looking right across the board.
Let's move on to Brexit, because we have been seeing the pound gain strength lately in anticipation of a Brexit deal. As the chairman for Brexit Watch, where do you think we're at right now? I mean, do you see the two sides reaching a deal in time, and what type of a deal would you ideally like to see?
Yeah, well, the deal that I would like to see is one which doesn't compromise our sovereignty and which allows us to diverge from the European Union. So I think any deal that ties us into the level playing field captures our fish, captures our military in PESCO and European Defence Union, and makes us subject to rulings of the ECJ. That kind of deal is a deal that I will be calling out, loud and from the rooftops. And I think it's very bad for the UK. It's not just an ideologically driven agenda. There is an economic reason for wishing to diverge. What we've had, Victoria, over the last 30 years, as the world has progressed through a debt-fueled economic boom, particularly the West, what we've had is increasing regulation from government, crafting social behavior in business. And that's great. In good economic times, that's fantastic, because you can drive a much better social agenda for the population in a country. But when you hit the skids like we really have now, you need to deregulate. You need to let businesses recover, because with every regulation, there's a cost. So you need to cut back that regulation so business can get back on its feet. And if we tie ourselves into a deal which prohibits us from being able to do that, we'll find that the UK will have a really slow recovery path. What we need now is to cut back competition law, allow state aid laws to be relaxed so the government can buy British first, so it can invest where it needs to in the British economy, cut back even employment laws so that companies are emboldened to employ. A lot of companies don't employ when employment law is rigid because they're fearful of the cost of then having to let staff go and so on. Whereas if you have a fluid employment market, you get recovery in employment much faster. And so I think we need to cut all those regulations back, and any deal that he does, I hope, will allow us to do that.
I mean, are you concerned about what could happen to businesses in the case of a no deal?
I'm not. which I've probably said to you before. And the reason I'm not is because no deal will only affect a very small proportion of British businesses. Actually, with the right policy agenda, we could profit handsomely out of no deal. You know, one of the things that has afflicted the United Kingdom over the last 10, 15 years in particular is this massive trade deficit and therefore current account deficit that we run with Europe. And we've seen pressure on the pound, you know, over a protracted period because of this trade deficit, which is about 100 billion a year. And a no deal would give us the opportunity to rectify that imbalance. It would allow us to protect British producers at the cost of German producers largely. And whilst, you know, I wish no harm to the European Union or any member state, you know, obviously our primary concern must be for the British economy.
All right, Ben, it's been great to chat to you. Thanks for talking through your interim results and providing some insight on Brexit as well. And that was Ben Habib. He's the CEO at First Property Group. I'm Victoria Scholar, and thank you so much for watching IGTV.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.